Welcome to Chapter 4, Securities Markets. An anonymous sage once suggested, a fool and their money are soon parted. Proverbs chapter 13 verse 11 tells us that wealth gained by dishonesty will be diminished, but he who gathers by labor will increase. And then if you look over in Proverbs chapter 21 verse 5, it says that the plans of the diligent lead surely to plenty, but those of everyone who is hasty surely to poverty. One of the things that we must understand as we discuss security markets and investing in the stock market is that the stock market is definitely a place where an unwise individual and their money will be parted. On Monday, October the 19th, 1987, the Dow Jones Industrial Average plummeted 508 points, a 22.6% decline in one day. That decrease in aggregate stock prices exceeded the decline that occurred on October the 28th of 1929. Then on March the 12th of 2020, the Dow Jones fell 10% in a single day. Now, we can point out that each of those instances are 3 individual days over the course of a century. And typically over time the stock market has risen. That is true. But there have been extended periods when the stock market declined. Prior to the stock market's historic crash in October of 1929, the Dow Jones had reached an all-time high of 381 in September of that year before bottoming out at 41 in 1932. So over the course of a 3-year period, there was a decrease of 89%. Although it eventually recovered, it did not return to its pre-depression level until 1954. 25 years later, quarter of a century it took for the Dow Jones to recover after the crash in 29. And so what we've got to understand is that when it goes to investing, you've got to be smart with your money, because there have been people that have lost millions in a day. And then there's people that's made a lot of money. And over a period of time, typically it does tend to increase and make money. But there are periods of time to where there can be losses, and substantial losses. So the chapter objectives is that by the end of this chapter, you will be able to distinguish between organized exchanges and OTC markets, brokers and security dealers, market orders and limit orders, trace the mechanics of a stock purchase or sale, compute gains and losses on stocks that are quoted with bid prices and ask prices, and explain the advantages and risks associated with buying stock on margin. Contrast long and short positions in stocks. Illustrate the mechanics of a short sale. List several aggregate measures of the stock market. Determine how American Depository Receipts, or ADRs, facilitate trading in foreign securities. And explain why an investor should not expect to outperform the market on a consistent basis. Market makers. Millions of shares and billions of dollars change hands every day via the stock market. The buyers and sellers never meet in person. Instead, the securities markets impersonally transfer the stocks and bonds from sellers to buyers. The transfer can occur on an organized exchange such as the New York Stock Exchange or the NASDAQ, or through a decentralized over-the-counter market. There are organizational differences between the exchanges and the OTC markets, but from your perspective as a potential investor, they truly work essentially the same. The OTC market is usually where smaller companies are listed if they can't satisfy the more expensive and restrictive requirements of the larger exchanges. However, larger foreign companies that are listed on other exchanges sometimes also sell shares on the OTC market in the United States. The Securities and Exchange Act of 1934 defines a dealer or market maker as anyone who engages in the business of buying and selling securities for their own account. Brokers and dealers do both. Every New York stock has a designated market maker, or DMM. Transactions are either sold round or odd lots. A round lot is the basic unit of trading for a stock, and it's usually 100 shares. Smaller transactions, such as 55 shares, are considered odd lots. For some stocks, however, the round lot differs from 100 shares. For example, inexpensive stocks a round lot may be 500 or 1,000 shares. The importance of the distinction between round and odd lots have diminished over time, especially in the stock market, because you can easily buy or sell 555 or 5,555 shares of IBM. However, the same does not apply to bond markets. You will not be able to buy or sell $55, $555, or $5,555 of IBM bond. So securities are bought through brokers who buy and sell for their customers' accounts. Brokers obtain the securities from dealers, and dealers buy and sell securities for their own account and facilitate the orderly process by which buyers and sellers of securities are brought together. Bid and ask prices. These are prices that are quoted by market makers at which they are willing to buy and to sell. So what it is, for example, the market maker set a specified price. For example, they may be willing to purchase a stock at $20 and sell it at $21. The security is then quoted 20-21. That represents the bid price of 20 and the ask price of 21. The market maker is willing to bid the stock at $20 and sell or ask the stock for $21. The spread is the difference between the bid and the ask prices. So let's review. What are bid and ask prices, and why are they different? Bid and ask prices are prices quoted by market makers at which they are willing to buy and sell securities. The difference between bid and ask prices represents the dealer's markup or profit. The mechanics of investing in securities. So after deciding to purchase a security, you can place a purchase order with a broker whose role is to buy and sell securities for customers. The broker and the market maker, or the securities dealer, should not be confused since they perform different but crucial roles in the mechanics of purchasing and selling securities. Brokers execute orders for customers. Security dealers make a market. They buy and sell securities for their own accounts. Dealers bear the risk associated with their purchases and their sales. A market order is an order to buy or sell a security at the best current price. So, let's say you're wanting to purchase stock in a company. You'll ask the broker to buy the security at the best price currently available, which is the asking price that's set by the market maker. This request is your market order. Now, one thing to remember, when you do this, you are not assured of receiving the security at the currently quoted price. By the time that the order is executed, the prices may have changed a little bit. However, typically and generally speaking, the order is usually executed at or very near the asking price. You can also enter a limit order. And there's two types of limit orders. There's a day order. That's an order to buy or sell at a specified price that is canceled at the end of the day if it's not executed. For example, if you believe that a stock is overvalued and it's going to drop, then you can put in a day order that once it drops to a certain amount, then you're going to purchase that stock. If it never drops to that amount, then the cancel is ordered at the end of the day if it's not executed. Then there's also a good till canceled order. And it kind of works in the same way, except it doesn't end at the end of the day. A good till canceled order is an order to buy or sell at a specified price that remains in effect until it is executed by the broker or canceled by the investor. So that stays in place until it happens, until the person decides to cancel it, or they get to the prices that they want to get to. Confirmation statement. A settlement date. That is the date by which a payment for the purchase of securities must be made. It's a date by which the delivery of securities sold must be made. So securities are held or registered with by the brokerage firm or the street name. Exhibit 4.1 is a confirmation statement of a security purchase. So in this, you bought 100 shares of Clevepack Corp at a price of $12.13. So the total of that would be $1,213. There's a commission on there because the commission is a payment to the broker for executing an investor's buy and sell orders, and it's how the broker makes money. And so the amount due is $1,264. And so you have 2 days in which to get this done. So the trade date is 8/16. The settlement date is 8/19. So the purchaser of this stock would have to pay $1,264 by the 19th in order for this transaction to become official. Margin. you may purchase a security on margin, which is the buying of the stock with a combination of your own cash and then credit supplied by the broker. The credit supplied by the broker is the margin. It's the borrowed funds. The phrase on margin can be confusing since it's simpler to buying on credit. Margin is not the amount borrowed, but it is your equity in the security, and it is often represented or expressed as a percentage. So if you own stock worth $10,000, but you owe $2,000, your margin is 80%, or 8,000 of 10,000, which is 80%. Margin can increase the potential percentage on a return or loss. So, for example, if the margin requirement is 60% and the price plus the commission on 100 shares of CleanPack Corporation is $1,264 from our previous example on that exhibit, the investor would supply, if it's 60% margin requirement, the investor would supply $758.40 in their own cash, and they would borrow $505.60 from the broker, who then turns and borrows the funds from a commercial bank. The investor pays interest to the broker on $505.60. The interest rate on that will depend upon the rate the broker must pay to the lending institution. Now, let's assume that you buy 50 shares of a stock at $20 per share for a total of $1,000. If the margin requirement is 60% and you put up $600 in cash and borrow $400 from your broker, if the price of the stock rises to $30, your position in the stock is worth $1,500. Your profit is $500. And you make 83.3% on your funds invested in the stock, which is $500 over $600, because that's how much you've borrowed from the broker. Now, had you not used a margin and covered the entire cost and paid $1,000, your percentage return would have been 50%. This is referred to as financial leverage. The short sale. The previous discussion, what we've been talking about thus far, is referred to what we call the long position. And that's where you purchase securities and in anticipation of a price increase over the long term. So you're looking to invest your money, and you're looking to invest it over the long term, and you anticipate that the prices are going to rise over the longer term. Now, one of the problems, though, is that at times the stock market declines. So can you earn a profit from a decline in the price of a stock? The answer is yes, if you establish a short position. A short position, you borrow stock and sell it. So let's think of this. Perhaps that a stock is selling for $39. You believe it's overvalued and that the price is going to decline. So you borrow stock through a broker and sell it for $39. Several weeks later, the stock is selling for $25. So then you turn around and buy the stock for $25, repay the loan, that is, return the stock to the broker. You made $14 per share because you purchased the stock for $25, sold it for $39. Now, one of the things, though, that can happen is if the price were to rise, say to $46, then you've lost money because in that case the stock would have been sold for 39 but bought back at 46. Short sales are common in business because a short sale is simply a contract for future delivery. Let's look at section 4.4, measures of security prices. There are different ways that the market and its subsets are measured. You have the Dow Jones Industrial Average, the S&P 500, the New York Stock Exchange, NASDAQ Index, Value Line Composite, Wilshire 5000 Total Market. And so all of these are ways in which measure the price performance of securities. And how well they have done over a period of time and the averages of what those stocks are doing. Foreign securities. Before we get into foreign securities, I do want to note that people will ask how have stocks performed? And the answer is dependent upon the time period that you select. For example, stock prices rose during the 1990s and then fell dramatically during the years 2000 to 2002. So if you sold near the end of 1999, you done well. But if you bought during the end of 1999, you probably sustained losses through the next 3 years. As of early 2022, many stocks were trading at or near all-time highs. For example, Avis Budget Group had never traded above $171.46 from 1983 till November the 1st of 2021, when it closed at $207.37. So in addition to domestic securities, you can also purchase foreign stocks and bonds. Foreign stocks trade on foreign OTC markets and foreign exchanges. And so one of the things, American security markets do not actually trade foreign shares, but they trade receipts for the stocks, which are called American Depository Receipts, or ADRs. This helps to avoid the problem of language. It's expressed in US dollars and not the local currency, and registered with the SEC. Then there's also Eurobonds, which are bonds sold in a foreign country but denominated in the currency of the issuing firm. Economics teaches us that markets will be competitive if there are many informed participants who may readily enter and exit. The securities markets are among the most competitive markets in existence. And because of this competition among investors, it has led to the efficient market hypothesis, or EMH. This is a theory that security prices correctly measure the current value of a firm's future earnings and dividends. What happens, in an important implication of this theory, is that you cannot consistently beat the market. One of the primary reasons for this is the speed with which security prices adjust to new information. New information, especially in our technological world today, is disseminated very quickly. Because of this, price changes occur quickly, which doesn't typically allow for investors to be able to take advantage of what's about to happen. And so the current price properly values the stock. Now, one of the reasons for learning what we're talking about and the material that we're covering in not only this chapter but throughout this course is that you will be able to better perform the various types of analysis that will increase your ability to anticipate events before they occur. Because if you're able to anticipate these events before they occur, then you can kind of get out ahead of the market. But typically, everything runs so efficiently and the information gets out so quickly, there can always be anomalies in the market. Those are few and far between, and typically you cannot consistently beat the market. If you look at figure 4.1, um, on 412 there was a sharp increase in the stock price of Nuance Communications stock. It went from 45.35 to 52.85, but then it leveled out fairly quickly. And so what happens is, because of the price adjustment in an efficient market, it happens so quickly that things change, and most investors weren't able to take advantage of this. Choose one index from any of the indexes listed in this chapter. For example, the S&P 500, the New York Stock Exchange Composite, or the NASDAQ, and so on. If you had invested in the index on January 1 of 2022 through January 1 of 2023, how did your stocks perform? And so I want you to go and look at that, and we're not going to do anything on Canvas on this, but it should enlighten you as to what takes place and what can happen uh, if you invest wisely and you learn to be able to analyze stocks and companies properly. This concludes our discussion of Chapter 4. Make sure that you read both Chapters 3 and Chapter 4, and make sure you complete your discussion activities for this week. I hope each of you have a blessed and wonderful week. If you guys need me for anything, please feel free to reach out to me via email. I will always try to respond to that within 24 hours, at most 48 hours. But I typically try to respond to all emails within 24 hours. Again, have a blessed week, and I will be back next week to discuss chapters 5 and 6.